Okay.
Side.
So as I said earlier, and this is just for the purposes of that, we're doing creative financing for buying. And the more tools you have in your tool belt to get into properties and potentially increase your wealth, the better you might be off, instead of just doing traditional, right? So one of the creative financing aspects is seller financing. So I'm going to leave it to you.
What is owner financing?
This is seller financing is also known as owner financing. And so basically what this is, you have an owner, and it typically is an owner who owns a property free and clear, and they are willing to be the bank for the buyer. So that's what owner financing is.
Yeah. It doesn't have to be free and clear. You can get a bank finance for part of it, and the owner can finance another part of it.
Yep.
Gets a little kick, but it works.
The other thing you can also do is if the owner does have a small note left still on, like they owes on the property, if the down payment is large enough to pay that off, then they can still owner finance. So those are different ways to do it.
Yep. Why would a buyer want to have a seller carry their note?
So a few different reasons on why a buyer would want to do that. One is it's quick. Like you could go into a property, see it. If the seller is willing to carry paper, the buyer could be like, hey, can we do this in a week? And we just closed on one, Frank's, in literally less than a week because the buyer and the seller came together. So it's fast.
That's one we need to talk about.
Yes. And then there's no lender involved, so the costs are lower, right? Like you have all these lender costs. You've got the origination fees, you've got doc fees, title fees, all the little fees that are associated. There's still going to be fees possibly associated, but most of the fees are like go to zero when you have a seller finance.
Long-term escrow is kind of set up that stuff, but
Mm-hmm.
small. So why would a seller want to do it?
So let's see. If the seller does this, there are benefits. One, they're going to get some money, like a down payment amount, right? So that might be enough to trigger them to be able to put their money into another investment. And then the other thing is it's fast again. So they don't have to wait around for the financing and wait for an appraisal to be done and wait for the appraisal to come in, which can sometimes be stressful. And then the other thing is they'll get monthly payments. So it's almost like they're getting rent payments, and those payments kind of stretch their tax liability and what they have to owe, for capital gains, whatnot, over time. So it actually is a benefit tax-wise for them. And they might be able to command a higher price because they are giving somebody a potential win because they don't have to go through the financing. So they might be able to increase that price or increase that interest rate. Right now, we're seeing people who are doing seller carries, the interest rates are at or maybe slightly lower than what our current interest rates are, but they're still much higher than when we were down in that 3.5 range a couple of years ago. So still getting the benefit.
Often a little bit lower. Maybe it's a difficult property to sell. They're trying to incentivize. They need to get it sold. So you incentivize with a lower down payment. Sellers are still going to want someone that they know there's going to make their payments. Isn't just going to move in, give them a little down payment, trash the place, give it back. There's still some vetting involved.
For sure. And that's actually part of the next question. It's like, who handles the transaction? So like when I've had people approach me and say, hey, do you know of anybody who can do an owner carry? We do have the ability as realtors we have this thing called a financing addendum. And that addendum basically spells out what that seller or buyer will agree on. One of the things is they could just agree on a credit report. And that might give the seller confidence, but they also may require a full financial statement and maybe over a couple of years to make sure that the people are vetted. And those are the sort of things that give the confidence to the seller that might be a good choice to go down, is when the buyer proves themselves to be be part of the financing.
Yeah, and oftentimes when we think financing, I know I always just go to a 30-year loan, just boom, like that. Often on seller financing, it's amortized out over 30 years, so the payment's the same as it would be over 30 years, but it might only be for 1, 3, 5 years. So it keeps that payment low for the buyer, but then there's a cutoff date. It balloons out. Buyer has to refinance, sell, come up with the cash, do something. So there's ends on it. It's not, sometimes it is long, sometimes it's short, but again, it's matching it to the buyer and seller need for that particular property and that particular situation.
Right.
The creativity of it.
Exactly. And so that's like where you get into conversations with your realtor about like what are all the nuances and how can we work this? And that's the conversations between the agents. Then once you guys come to a meeting of the minds on doing an owner carry, everything goes to the title company, and the title company then will, at least in our state, different other states are different how they run things, but in our state, they will draw up the note and they'll put in the terms that you've agreed, and they'll just run it through like a bank would, right? Here's your note and deed of trust that's going to be recorded. And then the cool thing about the title company is they can handle long-term escrow. So the buyer can send the payments to the title company, and then for a small fee, the title company will process that and send the check to the seller so that there's no kind of commingling between buyers and sellers. So that's a really nice thing. There is a setup fee. It's like $850, but it's worth every penny to not be too close, right?
Yep. So, why would someone not want to do it?
I think that if somebody needs to have the money, like all of the money from their property, they need the money. So that might be one reason why they wouldn't do it. They also, there's always the question, like, what if that buyer eventually defaults? They may be in a good financial position when they buy, but then when, like, let's say a couple of years down the road, all of a sudden the economy changes, they can't make payments. That is a con, right? Then all of a sudden you're like, whoa, I have to go through foreclosure. And it is a process. You have to know what the process of that foreclosure might be. That said, though, that con could be a positive. And the reason why is that you have, let's say you get a down payment on a property, and then you get monthly payments. And then the buyer defaults, and it's going to cost you maybe a couple of $1,000s to foreclose on and get them out. But then you get the property back. You get to retain everything that you have already received, and you get to sell it again. Possible win-win, right?
And hopefully they didn't strip the wire and the plumbing.
Yeah. So anyway, that is, I mean, the cons are like, the thing. One of the suggestions with these type of things is to, possibly do, like, have an agreement that in there where you're going to do regular property checks and just make sure that the property is well maintained during the time you have the note. So that's another way of handling that to ensure that you don't have.
And it could be written in the agreement, like when we've all gotten mortgages, you read through, there's whole sections, pages of, you will keep it insured, you will keep it maintained, do the banks check up on it? I've never been checked up on, but they could, and if you don't, they can take your property.
Yep.
That's a small font. That's fine print.
Sonja, have you ever had agreements where the seller might ask for updated financials from the buyer periodically?
No, that's a great idea, though.
We do that.
Do you?
Yeah.
Awesome.
Yeah.
So if you guys didn't hear that,
probably right into your agreement. We do it annually.
You do, yeah. So doing an annual financial check, that's a great idea to protect.
So what happens if, let's say, all of a sudden they're unemployed? They're still making their employments, but their financials just look like.
For us, it generally triggers defaults, and then we decide whether we want to
renegotiate or
if we're okay with it, and we have the option.
As long as they're performing.
Yeah. Yeah. No, it's a good point. Thank you. I appreciate that. That's great. So that's owner carry.
You want to go into an example at all, like a real life case scenario?
We could. Do you guys want an example? Like just for kind of some options? Okay. So you've got a seller who is selling a property for $600,000. You've got a buyer that has ample down payment, let's say $200,000. So there's $400,000 left. And I don't have the exact numbers as far as like interest rates, but let's just say that the buyer can prove that they can make the $2,500 a month payments at a certain interest rate. And so they they make an agreement that starting on the first day of the next month, they'll make these monthly payments. Hold on, losing my train of thought. And then, how does this go? Help me out.
So they agree on sales price.
Sorry. Yes.
Terms of the transaction, just like you would on any transaction.
And rate.
Yeah.
And term.
Yeah.
Right. Like,
so then
yep.
then you negotiate the loan part of it. So it's the purchase part. You negotiate the loan part of it like you would with a lender, and then the seller is acting as the bank. They collect a down payment.
Yep.
That's a nice down payment. That's 30%. That's a good down payment.
What have you seen relative to what that premium from a normal lender, mortgage lender, to a private money? What's the premium on that rate?
It's kind of a case by case, honestly, Patrick. I mean, there's some people that are super motivated, and if they have a unique property, they'll like make it super attractive.
Yeah.
And then you may have people who are like, I'll do this, but I'm going to charge 10%, and it's going to be for a year.
Yeah.
So it just really depends on the case by case.
And oftentimes a seller carry is a little different than a hard money loan. It's usually a little softer. They're kind of dating. Instead of, I'm paying for the date, but you're really going to pay.
Yeah, exactly.
No, it's usually just because the seller oftentimes just can't, or for some reason they want to do it.
Yeah. So sound good? All right, awesome. We're, the other type that we're going to talk about, we have three things we're going to talk about tonight. The second one is lease option, or lease option to purchase. So this is basically a rent-own sort of situation, right?
Yeah, and it kind of varies with markets. It's not super keen right now, but it can be very, very good for people that are renting and have been with people a long time.
Yep. So the pro for this is it might be for a person who can't get in otherwise. Like they can make the payments for the rent. They may have a down payment, but they don't have the credit. So it's a way for the seller / landlord to still get money, and the buyer / tenant to pay towards a bigger down payment, and then say a year or 2 or 3 down the road, then they would be able to purchase it. But that gives them time to build up their credit. So that's the biggest part of like a lease option for a pro, for a buyer.
Yeah. So
How does that get recorded if you're working?
It doesn't.
Through that bank transaction?
It's kind of like, so the way, like as an example, you would have a purchase agreement that is coupled with a lease. And so the purchase agreement would be executed at the end of the lease option. And so the lease, let's say the lease runs for a year. So nothing would get recorded for a year. They would still make payments. Typically that rent payment is slightly elevated over what market value is. And the reason why is that elevated, let's say that rent is $1,500 a month and the seller is getting $2,000 a month. So $500 a month is going towards that option money or that down payment for them to perform in a year.
I'm just saying, like credit services, how do they know that you're saying it would good way to build credit?
It gives them time to work on their credit.
Oh, okay.
the trans,
It's not-
yeah,
like,
the
it's
transaction
not-
doesn't
credit.
do it.
Yeah, it's building the buyer's credit. Like say they have poor credit, but they want to get in. It's a way for them to get their foot in the door and the seller to help
Work
them
on
out
their credit.
and then work,
Yeah.
like, yes, work on it.
And most often, as they're going into that purchase and sale agreement, there's an earnest money. As it's all coming, that'll go hard. That earnest money will
It's
get
non-refundable.
released to the owner, the seller, and it's theirs. If they quit paying, decide to move out, don't move forward, they're not going to get it back. So there's definitely some skin in the game.
Which is why maybe a seller would entertain it, right? Yeah. So, yeah.
Yeah. Pros for buyer tenant.
Pros is they can work towards home ownership. They have potential to build up some equity for maybe a larger down payment at the end. And they can lock in their price and terms. So I always find this as a unique option, but I find it challenging depending on who you are. If you are the seller, landlord, and you lock in on a price and the prices skyrocket, you're not going to be really excited in a year to potentially sell it. And vice versa, if you're a tenant and the prices skyrocket, you'd be really excited to have that locked in price. On the vice versa side, if the the prices come down, the tenant may not want to perform. They'd rather lose a little bit of money, that upfront money, and renegotiate. So it's one of those things where it is a way for people to get in. That said, it's something that the market, if it fluctuates too extreme one way or the other, you're going to have issues.
Yeah, back 2021, we put a buyer into one. The guy had it under contract, fell out. We'd had an offer. We came back around, 6-month lease option to buy. The kid made $85,000 in equity in 6 months.
But that was a unique COVID situation,
but
right?
the seller was just like, okay, let's do this. He'd already bought a property. He needed the income. It was covering his new mortgage payment. At the end of the day, nobody was sad. Even the seller wasn't sad.
On that, though, the option price
Yep.
actually is retained by the seller. It doesn't go towards the down payment, though.
No, there's an option price, and then the increase of those rents can go towards that down payment and closing costs.
Escrow. But so if you think I'm just renting to own and my landlord's got $20,000, $30,000, $40,000 a year, that's theirs. The lender's still going to be looking for their down payment
Yes.
at the time of purchase.
Yep, yeah. But part of the increased rent is helping them build the equity for their down payment.
And it can be written in. My guy, his $500 a month. So after 6 months, it was $3,000. It went to his down payment. We wrote it to that.
Yeah.
So it's
So again,
all
case
how
by
you come
case.
together.
Good question. Yeah. So kind of the things to consider is like if you were ever to entertain this, run a credit check. Make sure that they have the ability to perform down the road, right? Have a lender ready to get things in order for that person. One of the things I've done in the past with one of the lease options that I've written is, it was something like 3 months prior to the time for them to make a decision, they had to be pre-qualified. So they had, they had almost like a predetermined, yes, we can still get this. And if not, then what are our options, and make some decisions. So I think that the whole point of that is between the agent, between the buyer and the seller, you just keep talking and figuring out what their needs are. And then all of a sudden you can kind of push it all together and make it happen. So that's kind of how it works. Do you agree?
Yep.
Absolutely. Cool. This last one, do you guys have any questions? Any more questions on that? I look at Patrick. Nope. This next one, I would be really curious if anybody has done anything with this or not. Has anybody heard of DSCR loans? No?
Sounds like debt service coverage ratio.
That's exactly what it is.
Okay.
It's a debt service coverage ratio loan. Yeah. Have
Do you guys
do you do them?
A lot of our underwriting is based on that, but I don't know. Let's see what you're saying.
Okay, yeah. So this has been really cool. One of the things, it's kind of I don't know if it's a newer loan product, but it is a product that I'm seeing more and more with investor buyers. And basically what it is, first of all, you can't do it as your primary home. It has to be an investment. And instead of you having to qualify with your income and your credit score and all of that, you still have to qualify with your credit. You have to prove that you're viable, right? But the bigger part is that the income from the property qualifies for the loan as opposed to you having to qualify. So if you have an income property and it's making money that will service a certain loan amount, you can get the property. And it doesn't have to be on everything that you're making. Because say, like for us, we're, if you're self-employed, your ability to get financing could vary depending on your year of income.
A lot of
right?
people in here.
Yeah. And so this is a great way to get into some investing financing. So
Yeah. Unfortunately, you still have to have down payment.
in fact, quite a bit. Yeah. So
Your investment level, 25,
Yeah.
30%.
25% is probably 20. They say maybe 20%, but it's really 25% minimum to get into this sort of loan. And that just gives them the confidence. And it could be something like if you have a nest egg or something where you're like, I've got this, but I don't have the means to qualify. It could mean that the investment property could help you qualify for the property. So that could be a really exciting
Your home
thing.
equity line, cash out refi on your primary property, roll it into an investment property, and then have that income of that property making
Yeah.
those mortgage payments, and proving that
Is
it
that-
can.
So it's yes, if we're loaning solely to, like, say you have an LLC and it's your investment company and you're buying investment property, if we were loaning to that entity, you could qualify based on your debt service coverage ratio. But because for banking, we like to be protected, we're also going to ask you to personally guarantee the loan, probably.
Right.
So you have to qualify on an income level.
Okay. And that's on the commercial side, right?
Right.
Yeah.
I don't live in residential.
Right.
So.
And on the residential side, I haven't seen where they make that personal guarantee.
No.
So it's really based on the income from the property, and the rate. How does it say? You take your annual gross rental income divided by the principal, interest, taxes, and insurance, and if you have any HOAs, and that's how they determine that ratio. So when you get a regular loan, it's your, what's the ratio? Debt to income ratio, right? So this is just the debt service to income ratio. So
What does that number look like?
it depends.
Depends.
It depends on what the income of the property is. What I did learn about it recently is it's not based on what you say the rent is going to be. They're going to send an appraiser out to the property, and the appraiser is going to determine on that rental amount. And it is what the appraiser says the rent amount is for each, like if it's a multifamily and the appraiser says, well, it's going to be $1,000 per door or per unit, then that's what they're going to base it on. But if the realtor in the transaction says, yeah, but you can get $1,200, they don't care about that. They're going to base it on what the appraiser
Did they
says.
take the appraisal over contract?
What's that?
Would they take an appraisal over contract?
No, that's if it's vacant and you're going to
Yes,
be
exactly.
servicing that.
The contracts would be.
They would help the appraisal. Yeah. So they approve the price. Yeah, the market
Although
price.
in a lot of places around here too, people are rents are below market. So you go to do that, an appraisal might help you. If that building has been owned by the same guy for 500,000 years, and it's a 3-bedroom, 2-bath, 2-car garage, and they're renting it for $800 a month. Woo! It's going to sell. If let's say it's 4 doors, it's going to sell way more than that. Those rents aren't going to help you much. But if an appraiser comes in and says, "Oh my gosh, you could be getting $3,200 a month for that," that's going to change the picture a lot.
Yeah. So, and these loans take about 4 to 6 weeks to do. And a lot of the lenders, that's like the residential lenders that I've been working with, I've asked several, and a lot of them do it now. It's one of their loan products. And I think it's just trying to help people. I think a lot of us over the last few years have quite a bit more equity in our properties. And so we can take some of that equity and maybe roll it in and then have the investment be the part where you can keep things moving and keep building your wealth. So, yeah.
I'd imagine the appraisals take a little longer to
Still
get
4
the
to
rent
6
rolls
weeks.
up.
Yeah. It's about just average. Yeah. Any questions on DSCR loans?
You said you see those from single family homes through commercial.
Mm-hmm. Yep. But a lot, like your probably best bang for your buck is like a multifamily. Yeah, because it brings in a little bit more income possibly based on the price of that property. Depends on where you're at, right? Like if you're looking here, it might not pencil. If you're looking maybe in a place where there's like lower prices and good rents, it could really pencil. Yeah. What other questions do you guys have?
Would you share Frank's story? Just on that, just how he was able to help somebody. It's a really unique, cool story.
Yes.
It's not a story, it's true. We just had a really unique interaction with a client of ours, and his long-term renter rented from him for like 10 years. And, might have stepped on some toes on the way, but we have a really happy seller and a really happy buyer.
So this gentleman who owned the property bought this property in like 2008 or 9, kind of a good time to buy possibly, right? When everything was just completely low. And then, and he's been getting great rents, been moving the rent up. His tenant's been able to keep up and they've just had this really nice thing. And this gentleman's probably in his mid to late 80s. And he's like, I want to help this tenant out, like get into some home ownership here in the Valley. And so they agreed on what they would call a affordable housing unit, right, which is about 20% below market. And so they agreed on about 20% below the market for him to sell it at. And then he did an owner carry, and he equaled the rent rate that the gentleman was paying, and that turned out to be a 3% interest rate. And then he just carried it, and he's like, I'm carrying it for 30 years. And
which
he will not, he will,
that was the super kind part.
That was the super kind part. The thing is like his estate, because I don't think, if he lives for another 30 years, awesome, but I don't see that happening. But his estate is going to take care of it from there on. But the funniest part, or the coolest part of this, is he's like, I just don't want to be a chump. That was the word he used. He goes, I do not want to be a chump. And he goes, what I mean by that is, if I sell this to you for 20% below market and give you this great interest rate, I don't want you to turn around tomorrow and make money on it. So he worked into the note, and had, for the first year, if he sold, he gets 100% of the profit. The second year, he would get 90% of the profit. And so this gentleman has to own it for up to 10 years until he gets all of the profit. So it's just a way to protect himself and not have somebody take advantage. Not that they would, because they had a great relationship, but that's an example of a kind of a heartfelt owner carry.
And it kind of got its start is the gentleman had reached out to some of the local programs to qualify, and they approached the seller, and there was, and some of them are deed restricted in lots of ways, including appreciation. Others aren't. There's all different ones of them. That definitely we're
learning.
We're trying to keep
Always
up
learning.
and learn. And they're always changing. And our first reaction when he came and asked us about should I participate in this program was like, hell no! It's going to restrict your buyer to 3% appreciation per year. That's a terrible investment for somebody. And it ended up this program did not do that. But then as we got conversing around it, it was like, this is something you can do off market, out of program, someone that was wanting to make a difference in workforce housing. It was really cool.
It was a really cool story. So anyway.
I've done it for employees before. I rent my employees, but I give them $5,000 a year equity. And when I go to sell the house, for every year that they stay in the house, they'll get $5,000 per year. They're there for 5 years. I'll give them a check for $25,000 for down payment help. Obviously, I'd have to 1099 them, but at least it allows my employees to someday incorporate our house.
That's creative. That's awesome, Brian. Yeah.
No, I built that.
Oh, I got a kid.
That's awesome. Brian's like, I might take you up on that.
All right.
That's awesome. Do you guys have any questions on those? Those are 3 ways of just new tools possibly for helping. What do you guys think? Good stuff? Awesome. Cool. Well, I think that's what we have to present. I'd love it if we have a little bit of food over here, some snacks, some food, some drinks, and we're good. So let's just, mingle. And I do have to say that when there was a person that came to our last month's meeting that I just helped facilitate a wholesale property for. So this is working. So if you do have things where you're like, oh, this is working, like, let me know if I can help, and we'll figure it out. So sound good?
I want to just add real quickly to the real creative portion. I started out with on using an asset like either a home equity line of credit or using cash value life insurance, we're talking about. They work is very similar, where as you build equity in either of the 2 contracts or 2 assets, you can loan yourself that money back. Through a home equity line of credit or you loan. Or you can actually take a loan off that cash value of the life insurance, use that cash value of the life insurance, then stay, or similar in concepts. One's under a real estate
asset versus
the other is a life insurance contract.
Is there a charge to access that? Is there a fee? Do you have to pay it back?
Okay.
I know a lot of people borrow off investments.
Interest rate on the amount that you take out.
Similar to HELOC,
Similar
right?
to HELOC.
Because you're paying an interest rate on the loan of the money you're borrowing.
But it's actually very similar to a HELOC is you're not required to pay it back, but when you sell the house or you pass away, then that's realized. And the loan then is realized either on the price of the sale of the home or it's realized on the death benefit of the life insurance. So you actually don't have to pay it back, but then the beneficiary or the estate plan or the legacy plan will be reduced by that debt burden on that. So that similar concepts, change a little bit of language. Sometimes you have to qualify for real estate, qualify for that through credit. The other side of that is you qualify through your health or you qualify through underwriting. So just different ways to do it. And then if you were to take out a cash value loan, you could apply that where you need to, and it wouldn't be seen on your credit.
Right.
So if you're either trying to stay off of credit or the numbers are too close, if you were to take out too much, debt to income, etc., then that might be a nice place to pull that from. So then you could put it towards real estate.
Yep. And then you could layer that, like that could be a down payment amount, and you could layer that with a DSCR loan, or right, like there's lots of creative ways. So that's part of the reason why we can network and talk and get to know people that know things like this.
I think having on private financing, a rental on a private loan doesn't show up in your credit report.
Yes, that's true. That is actually a pro.
But we're gonna ask you.
They're going to ask about it.
No, you're right. They don't show up.
It would show up, but it'd be recorded loan, and so you'd find it.
No, we wouldn't. No, I mean we wouldn't. You would probably tell us that you have this, debt. But yeah, that never would show.
Yeah, no, that's good. Awesome. Any other questions? No? Thanks, you guys.
Thank you so much.
Super great. Grateful for you coming.